on here. Number one, all of you should know stock and options trading has large potential rewards, but also large potential risk. All right. The second thing is that me, Jay, and everyone with Tom's Trading Room and Optionetics, we're here as your educators. All right. We're not personal investment advisors. We do not give specific trading advice. You need a broker to trade with. You must meet certain requirements. And everything I'm going to talk about tonight is in US dollars unless noted otherwise. Let's go ahead and get going. So this is just a quick bio on myself. I've been trading in the markets longer than I haven't. I mean, I've been trading longer than I haven't trading, meaning that I've been doing this over half my life. All right. For those of you that don't know, I co-founded Optionetics with my great, dearly departed friend George Fontenilles. We had over 400,000 students that went through our intensive 2-day courses. As many of you know, Optionetics was it merged with Options Express, which was then sold to Charles Schwab. I was a managing director of Charles Schwab for a couple of years. And of course, when my time was up over there, I went right back to work, wrote another book, and also started Tom's Trading Room. And as some of you know, we went back and purchased Optionetics back from Charles Schwab. It was actually a win-win, simply because they're such a big company, and this was not something that they were that they looked at as something they could add a lot of value to. So they actually came to us, and we decided to pony up and buy the company back, and do that really for the students, because we also noticed that the students weren't getting the kind of education they were used to getting. I don't think it was anything on Charles Schwab's fault. I think it's just big companies. So we're glad to have everybody back. And so a couple other things. You guys know I'm an author of several books in the markets. I've been on TV, not as much as I used to, but I've done CNBC, Bloomberg, Reuters, Fox Business, and more. More lately, I'm actually on CNBC Asia. So I tend to go live to that market at night when it's their power lunch. So it's kind of the same as power lunch. It's called Capital Connection. You can see me on there every so often. For those of you that are tuning in from, say, Singapore or Australia, like I said, feel free to look for me during the day because I'm there every once in a while. Also, you know me by the founder and editor of TomGentile.com, Tom'sTradingRoom.com, and Tom'sOptionTools.com, which is where we're going to be spending a little time the next few weeks. Happy New Year, everybody. It's a new year. That means, guess what? A lot of us have already broken some of the New Year's resolutions that we just put in place not only 2 weeks ago. I'm trying my damnedest to stay in shape. It's kind of a new year, and I want to try to push myself a little bit more. It's hard. It's hard to keep resolutions. You know what you need to keep a resolution? You need a coach. You need, someone who's going to be there and really just kind of poke you and badger you into making your goals. Consider me your financial coach, all right? Your coach when it comes to trading and options. Because I'm going to poke you and I'm going to badger you to continually, do what you need to do to take your finances into your own hands, all right? We do this through a number of things. These free webinars, which we do a lot of, all right? But we also do, we also have a software platform, Tom'sOptionTools.com, and we have a free limited time subscription to those. For those of you who've never joined us or thought about it, I'll show it to you later on this evening. Also, we do have what we call advanced seminars for what we call our mastery members, and we do a partner program, which is a once-a-year program where it's basically our kitchen sink. It's everything. It's tools. It's seminars. It's live seminars. We have a cruise that's going on at the end of this year, which is kind of our graduation cruise. You get access to things like even my cell phone number, which I don't give personal or specific advice, but I'm there for everything else. And so, that's something we do for our partners. It's a once-a-year program. And like I say, guys, premium education, our partner series, these all are really kind of stay the same for those of you that are with Tom's Trading Room. Nothing's really changing, and let's keep trading. So we're going to do these webinars this month, the next 3 Wednesdays from 8 until 9-ish. All right. Recordings are made available, and I'm going to have the slides to you as well. So tonight, all about calls, all about puts, trading the flying five using what I call leap options. All right, we're going to look at that. Next week, we're going to get into spread trading. We're going to get into darknet, and we're going to get into money calendar strategies. All right, and then finally, week 3, we're going to talk about credit spreads. And we're going to talk about trading what we call layered credit spreads. And my guest, Devin Pearsall, will be on that webinar with me. Okay? So let's start, for those of you that are brand new, and I get this question all the time, especially from our new folks, is that there are 20,000 roughly stocks out there in the area. How do you bring those down to a scalable list worth trading? All right. And what we do is, obviously, I like to find trades that are optionable. But if you notice, that's not the first thing we look at. We look at market liquidity. We look at what we call stock mobility. All right. Something that moves. And then finally, is it optionable? And so what we can do is, by going to this website, www.cboe.com, you can find the greatest liquidity in the stock market by simply going to this area and clicking on this tab. And so if I clicked on this tab, it's going to take you right to the CBOE. And I just did that just now. So if you scroll down, you'll see the CBOE website. All right. Now, I could take you in here and we can move into products and we can move it all over the place, but I'm going to probably end up losing a lot of people. But instead of going to CBOE, how about we just go to our friend Google? All right. So I'm going to go to google.com and I'm going to type in penny pilot program. Penny Pilot Program. Now, what that does is that takes you back to the CBOE again, but it actually, the very first one up here says Hybrid Penny Pilot Program at the CBOE. I want all of you who have never done this before to go there. And then you're going to see it where it says Penny Pilot Program here. Right below it, it says click here for a CSV file of Penny Pilot classes. Now, I have now downloaded, by clicking on that, I've now downloaded a Penny Pilot classes folder. I just want to show it to you real quick. So now I've opened up my spreadsheet, which I use Excel, but some of you may use Google Docs. Whatever it may be is fine. But what I'm showing you right now is I am showing you some stocks, not 4,000 optionables. Let's see how many we got here. There is 417? No, 416 actually, because I think the top's a header. Yeah, the top's a header. So 416 stocks. 416. All right. That's a number I want you to think about. That is roughly what's the percentage of 416 on, say, 20,000 stocks? That's really low. On 4,000 optionables, we're talking about something just over the 10% mark. So we're dealing with the top 10% of all traded stocks right here. And then we can even make it even better by going through and scraping these stocks right here to find the ones that actually have weekly options. And then that brings you down even more. All right. So Penny Pilot classes. Again, where did I get that from? I got that from Google. All right, I got that from google.com. I typed in Penny Pilot and brought me to the Penny Pilot program. And as you'll notice, every so often, and I go over here about once a quarter and I download that list and I actually put it into Tom's option tools because we use that on a regular basis. Now, every quarter, some stocks will drop off, some stocks will come on. All right, so it's quarterly. I do some housekeeping getting that into play. So what have I shown you so far? Basically, what I've shown you is how to find the greatest liquidity in the stock market. And we found that Penny Pilot list, and we were able to do that again through cboe.com. All right, you just go to Google. You Google Penny Pilot Program. You come and bring up the Penny Pilot Program itself, and there you're then going to click on the link that says click here for a .csv file of Penny Pilot classes. It is so simple to do. It's basically a two-step piece. All right, so we took ourselves from 4,000 to roughly 400, the top 10% of all optional stocks. And we'll incorporate those Penny Pilot options and weeklies into one group. And I like to call those pennies and weeklies. And pennies and weeklies takes this 400 down to around the 325 area. Okay. And again, it's just a way of taking lists and putting those lists in and scraping out the good stocks from the bad. Now, why those 400 or 325 if you add the weeklies in? Well, it's simple. They have the cheapest, or not the cheapest, they have the thinnest, most efficient bid-ask spreads. Okay? They're going to have the most volume, so that's part of the reason why that bid-ask spread is so tight. and we want to trade those, I don't typically go outside of those 400, because when you go outside of those 400, now you're becoming more of a bigger fish in a smaller pond, and you end up giving up a lot to the other side of the trade. All right, it's harder to negotiate when there's not a lot of buyers when you're a seller, or where there's not a lot of sellers when you're a buyer. All right, there's room to negotiate inside those 400 penny pilot stocks. So why do we trade options on those on stocks at all? 3 reasons. Number 1, control. All right, what we're looking to do is we're looking to control a minimum of 100 shares, and we're looking to do that for a small price. All right. So, for instance, if you take a look at Priceline.com today, Priceline.com hit $1,872. That's going to cost you $187,000 and change for 100 shares. All right. We can control Priceline.com for a lot less money. All right. Number 2, we have the ability for protection. And protection allows us to go in and protect a stock or protect a portfolio. And that might be, if you have stocks, you could protect it buying puts. You could protect it selling calls. You could protect it with spreads. There's several different ways that you can go out there and protect stocks, besides just sticking a stop loss out there and hoping that the market doesn't gap below that loss. Okay. And then finally, there's number 3, paying for protection. And that's a way of offsetting options. Offsetting options are what we do with spreads, whether it's a directional spread, like a bull call spread or a bear put spread, or maybe it's non-directional, like a straddle, right? But paying for protection allows us to offset either options, or we can offset direction. And those are the 3 reasons I trade options. Now, let's go ahead and focus for a few minutes on trading call options. So, call options are, simply put, the right to buy. That's it. Just think of calls as calls give you the right to buy. There's no obligation to it. All right, well, what are you buying? You're buying an option on a specific stock. You're going to buy it for a specific price, and you're going to have a specific time frame in which you could exercise that option. Okay, puts are the exact opposite. They give you the right to sell. So, let's do a quick case study. This is a case study that we were looking at late last year, but it is just a case study because I'm going to show you some real-time trades using calls a little bit later on in the program. All right. So take a look at Apple here, and we have an ability to do a lot of things with our tools. One of the things we do is we look at channels. So you see the channel on here, but that could be one of the reasons that Apple was a case study late last year. All right, so we're looking at Apple. We see, okay, yeah, this thing's trading around 153 and change. And of course, what if I have the right to buy Apple at 155, but I'm going to pay a fraction of that right? Well, that's what an option is. So when you look at questions that come in for people who are brand new with options, these are the top 3 questions they always have. How many options could I buy at $155 a share? All right, well, that's called the contract size. Can I buy Apple stock options at different prices other than 155? Yes, it's called strike prices. How much time do I have on my option? Well, that's called your expiration date. Let's dig into each of those just for a moment and look at some details. Contract size. So one contract is good for 100 shares of stock here in the U.S. and many other countries. There are a few countries, however, that have options that trade for one contract equals 1,000 shares of stock. All right. You might think those countries are crazy, third world, leveraging their options to the hilt, but they're really not. These countries that have the 1 equals 1,000, that formula, that's because the majority of their stocks are less than $10 a share. And they've got to create something that has some real leverage because, if you're looking at a stock that's, say, $7, why buy a call option on a $7 stock when you just simply buy the stock for $7? So that's why they offer that higher denomination. But that is few and far between. Most of the world, and of course the US, is 1 equals 100. All right. Next detail, strike price. So the strike price is the price that the buyer and seller agree upon. All right. So think about an option contract like a real estate contract. You're basically right. You want an offer to buy Apple for 155. Well, someone's got to sell it to you. Okay. And there is a seller on the other side of that contract. Now, you might wonder, well, why is that guy or gal on the complete opposite side of me? Do they know something I don't? Well, maybe they do, maybe they don't. All right. Can a buyer and seller of Apple's 155 call options? I'm going to ask this question. I want to see what you guys have for an answer. Can a buyer and seller of the Apple 155 call both be bullish? Yes or no? Punch it into the Q&A box now. Can a buyer and seller both be? I mean, we've heard the term that options are a zero-sum game, so for every buyer, there must be a seller, all right? But I see a lot of you punching in yes. Anybody want to give me a clue as to why there are so many yeses in here when there's a few people saying no and they probably think they're right? All right? The answer is yes, by the way. Okay, gotcha. Eeyores is right. John is right. Phyllis is right. Warwick is right. I could name, there's probably at least 100 of you punching in here with answers as to why that is, and you are all correct. All right. And the answer for those of you that are not sure is that I want you to think about this. The buyer is buying the contract because he or she believes Apple's going up. What if the person that sold the contract actually already owned the Apple stock? What if the person that sold that contract to the buyer was really creating a covered call? All right. Isn't a covered call bullish? It is. So you've got a buyer and a seller that are both bullish on Apple. I know a lot of you probably thought that was a trick question. Some of you are keying in like right now going, oh, that's right. I didn't think of that. Absolutely. Okay, that's just one way that you can be bullish. Now, there's several other ways with spreads too. Spreads, you can be bullish. Maybe the person that's selling the 155 call is long the 145 call. So they're bullish on Apple too. All right, so these are a couple of ways you can be bullish on Apple while selling a call option that someone else is buying. Okay, so that's strike price. The next is expiration date. And expiration dates, there's several different ones. Most people, if you've been under a rock for the last several years, you may think the third Friday of each month is the options expiration date. Well, I got to tell you, that's changed. That's actually changed since, probably going on 9 years now. Weeklies. All right, weeklies expire each Friday at 4 p.m. So we got an option that expires every single week of the month for not all options, but I can tell you there's a good 325 of them that have weeklies. Outside of that, yes, you got the third Friday of the month. There's also options that expire on Wednesdays. All right, there are Wednesday option expirations, which are relatively new. In fact, if you want to know my opinion of them, I don't have one because I don't trade Wednesday options yet. Okay, I want them to be around for a year or two. And then I'm going to start looking at them more intently. And then, of course, then there's EOMs. Those are called end-of-the-month options. There are quarterlies, which expire every 3 months. And then there are leaps. And we're actually going to be working with leaps tonight. And so that's my plan for tonight's live case studies. Which are best? Well, they're all good for something, right? But if I were to tell you which ones that I do not trade, I don't trade the Wednesdays. I do not trade the end of the months. I rarely trade the quarterlies. Everything else, I like. All right, I like it in moderation. How about that? I like options in moderation, kind of like wine. It's in moderation. So again, what do we have here? I've got a blue box which shows options that expire on Wednesday. I've got a green box which are weeklies. The red box is the third Friday of the month, and of course, this particular box down here is the EOM, the end of the month, the last trading day of the month expiration. So where can we find these? Well, if you go into Tom's Trading Room or tomsoptiontools.com, you can find all the information out here. So we could go in and we can take a look at things like the expiration date. I like to look at the number of strikes too because that helps me find liquidity. And of course, days to expiration as well. On the right-hand side, we have controls. We can look at everything for things that I like to look at, like percent to double. We can rank by Greeks. We can rank even by Delta quotes and Greek quotes. So we can really get really advanced in here. But for most of us, percent to double to me stands out as something that I want to know about. All right. So if I were to go and take a look at Tom's option tools right now, let me just pop in here real quick. Let's open this up so I can use the full screen. That's good enough. Let's go over and let's look at some options. And I'm just going to go to option chains. I mentioned Priceline.com. All right. PCLN. All right. Our advanced students that catch us every day of the week live with the markets know that on Monday I was preaching about Priceline.com as a bullish trade. And so I can show you here, we can actually go back and we can back test. So I can actually go back. Well, Monday morning, we were looking at Friday's prices because Priceline.com had actually dropped a little bit Monday before it started scooting up. So let me show you what this looked like coming into Monday. So we're looking at Priceline, and we were actually looking at a specific trade. I'm going to show you what type of trade that is next week. But I want to show you what we were looking at in terms of prices themselves. So we're looking at February options. All right, I was not looking at the Januaries. They're gonna fall apart too fast with time value. So I went out to February. We're looking at the February 16th options. Why February 16th? Well, count them with me. 2, 9, 16. That's week 1, week 2, week 3. Week 3, look at the strike prices on there. Week 1 is 139, week 2 is 102, week 3 is 152, week 4 is 123. I'll take the one with the most strikes. I'm going to go ahead and click on, let's click on update. I mean, this 10% means I'm going to go 10% above and below that price of Priceline.com. Look at all these strikes. It's incredible. 1823.54 was where we closed out on Friday, and we actually opened on Monday, all right, and actually traded down to 1805 Monday before moving higher. So I'm showing you this because what you see here right now is you see the options that expire 0.1 days before expiration. Right, that basically is expiration day. What I need to look at is the February options, and they're on there, but I'm going to get rid of the January 5th options because they're not worth looking at on January 5th. There we go. So take a look at this. Now, we have an option here that has how many days to expiration? Come back up here and take a look. 42 days remaining. Look at how much they cost. They are $42 for a call option. All right? Wow. That's for the at-the-monies. Okay? Now, I want to show you real quick. We're just going to buy one of these, even though that would be insane. I'm doing this just to show you an example. All right? So we've got our call option example here. We've got limited risk. Although it's a lot of risk, it's limited. We have unlimited reward up until expiration. Okay? We have a break even on this thing that is insane at $1,867. All right, or so we might think. It's a bit pricey. I don't like my options trades to be more than $500 a contract. All right, unless I'm looking long term, like next year. But I want to show you something else we could do too. We have the ability to back test, and what I'm doing is I want to show you what happens here. So we have an entry debit of 4205. All right. We also know we have maximum profit, which is unlimited. We know our risk is what we pay for the option itself. We go plus a day. This is what helped me learn about options. However, I got to tell you this tool wasn't around when I first started learning about options. I was using a legal pad and a number 2 pencil. And I noticed, wow, look what happened in one day. In one day, we all of a sudden have a 45% gain on these options. So even though they costed $42.05, they're now worth between $60 and $62. Let's hit that button again and let's move forward a day. Now this is now Tuesday, right? Now we're up $2,900 on the trade, or 69%. Where are we at today on this? Let's just go ahead and click on the latest. And you'll see the trade is up now 76%. Now, I don't care how much this is up. I can tell you that everyone in the room, maybe one or two of us, Most of us in the room would have looked at this and laughed on Monday and said, there's no way I'm paying $4,000 or $4,200 for a contract of Priceline.com. But what would you say if I told you you could have done this for less than $300 a contract? All right. Save that, because we're going to come back and look at that again with this example and more next week. All right. But what I wanted to show you is how a call option moves with the price of stock. The stock price is now at, if you come and look over here, the close was 1872.91. So the stock has moved up. We're going to call it about 65 points in the last 3 days. What has the option moved up now? All right. You could take this, the look at 42 to 72, and it's about 30 points. So the stock's moved up 60. The option has moved up 30. Okay. The option has moved half the rate of the stock. All right. So although we have limited risk, we have a limitation on what the options are going to do relative to the stock price. All right. We'll come back to that in a little bit. But like I said, I gave you a real live example. Here's an example we did using Apple. So we looked at Apple options, the same thing, 150s. There's the 155s. Here's 160s. Okay. Now, something else that happened with those call options from Priceline. They were two of these three definitions, right? In the money means it had real value. Out of the money means it does not have real value. And at the money meant that the stock and strike prices are the same, but had no real value. We were an at the money call option with Priceline on Monday. We are now an in the money call option with Priceline today, because now those, I'm sorry. Let's start over again. We were, an out of the money option on Priceline.com. All right. We're now getting very, very close to an at the money call option. The thing is that again, let me slide over here. Take a look at this. The strike price is an 1825 call. Let's do it one more time. My mistake. It's the first of the year, guys. I apologize. We were an at the money option. We are now an in the money option, because look, our at the money option is no longer, stock's not at the money anymore. The stock is at 1872.91. We have an 1825 call. We now have a lot of real value in this option. And I apologize for going through that faster than I should have. All right. But again, we saw a call option that was at the money that is now in the money, meaning it actually has real value. As these get more and more in the money, what happens? You gain something and you lose something. You gain profits. What do you lose? You lose time value. Okay? Because you lose time value, you also lose the risk of future time value. But what do you gain on the risk side? You gain the fact that if this stock comes back down, this thing's going to crash harder. All right? That means you're going to have what's called price risk. All options have two types of risk. They have price risk, or they have time risk, or they have both. Okay? So that's our definitions of option, of the type of options being in, at, or out of the money. Now, volatility is another piece of an option, but it relates itself to time value. So when I say you have two risks, you have price risk and you have time risk. All right, your price risk can be related to as what's called a delta risk on an option. Your time risk is also related to as theta, but it can be related to volatility also, because the volatility in an option, or what's called its implied volatility, is based on the actual time value, not the real value. So volatility is the speed of the stock relative to time. And there's two types of volatility. I just mentioned one, which was implied. But statistical is what has the stock been doing lately, right? And implied is what has the option pricing, what are we looking forward to in the future, and how is that equated into the option? Now I'm going to show you, I wasn't planning on doing this, but I'm going to show you guys an option that's got a lot of super volatility in it. In fact, we just put it on Tom's Option Tools not too long ago. It is the first optionable Bitcoin or cryptocurrency stock, all right, that's on our website. And that is RIOT blockchain. Symbol is RIOT. Riot Blockchain. Let's take a look at this. I'm going to tell you something. This is not a penny pilot stock, all right? And it's not, and it does trade weeklies, but it's not a penny pilot stock because you'll see what I mean here in just a second. So Riot Blockchain is a company.
You want a current date, Tom?
Excuse me?
You still have it for 1/5. Do you want it current date?
Well, yeah, let's go ahead and push it up to today. Either today or 1/5 doesn't really matter. But if you notice here, we have options to expire second week, third week, fourth week, week 1, week 2, week 3, week 4 of February. Then we have March. That's the third Friday in March. Then we jump to June. Then we jump to January 2019 and January 2020. So very, very quickly, this stock became optionable. It became a weekly option, and it also has leaps. All right. What it doesn't have yet is, well, you'll see. All right. It doesn't have a lot of buyers and sellers in it. There are a good bit, but we're not talking Apple or Facebook here. All right. So let's take a look at some of these. So I'm going to just punch to the options that expire next Friday. Okay. You guys didn't think this was going to be a webinar on cryptocurrencies, but remember, this is a stock. All right. This is the stock that actually is in the cryptocurrency space. But take a look at this. So here's a stock that's $22.94, roughly 23. Look at the at-the-money call, $1.53. I want you to look at a couple of other things here. $1.53, you might say, wow, that, I don't know if that's cheap or expensive. Right? There is one way to figure that out. And so what you do is you look at implied volatility. And you look at it right here. I've got the IV, I've got the bid, and the ask. Now, 108. Okay. Now, is that high or low? And you might say to me, compared to what? All right. Well, let's look at comparing it to something. So I'm going to buy a Riot Blockchain 23 call. Remember, this is a case study. I'm not buying any Riot Blockchain calls, but I want you to take a look at something. See, we've only had this on for not even a couple of weeks. So I don't have the data that you might see. What I do have is I have a stock that's been dropping every day. I also have an implied volatility that was up here in the 150s that's been dropping too. Right? So it is high implied volatility. But what I want you to take a look at is the fact that this stock was traded at 28. It was like a week ago, 2 weeks ago, right up here. And now you see it down here in the 22 and change area. All right, well, it's going to have high implied volatility because guess what? Bitcoin and all of their brothers and sisters in the cryptocurrency markets are all over the place. Let me just give you an idea. All right, this morning Bitcoin was trading at $13,635. It went to a high of near $15,000 before falling off and ended up at $14,450. That's a lot of movement. It's a lot of movement in that for one day. Okay, you think this is going to have something to do with that move too? It is, right? So keep that in mind. High volatility. Do you think that the volatility has something to do with the price? Right? You might be looking at this saying, well, $1.53 isn't that much. Well, it kind of is. All right. But if you really want a better idea of what I'm talking about, then look out a couple of months. You might want to say, well, gosh, Tom, you're going to be talking about leaps later tonight, aren't you? Yes. All right. I'm going to talk about those in a few minutes. Let's just look at a leap option. What would Riot Blockchain's call options with 373 days to expiration look like? Now, I'm going to tell you this before I turn this down here. I haven't looked at this yet. All right. This is what you get when you get live. You get live, and some of the live is really live. Look, check this out. $5.80. Okay, $5.80. Right now, I got to tell you something else too. When you look at the $5.80, I want to show you something else here as well. Take a look at what the 23 put's trading for. The 23 put is $12.25. What the heck is going on here? The 23 call. This stock's a 23. 23 call 580, 23 put 1225. What is going on here? Help me out here. Can I buy the stock and buy the put and sell the call? No, that'd be stupid. Can I somehow figure out a way of selling this call or selling this put, buying this call and shorting the stock? yeah, if you could short the stock, that might make a lot of sense. Because there's such a disparity between the 62 IV on the calls and the 151 IV on the puts. Okay? Again, knowledge is the key here, folks. We have to understand why in the world these calls are less than half the price of these puts when they're both pretty much at the money. I can guarantee you tonight I've shown every single one of you in this room something you didn't see before. All right? I can tell you right now, I'm seeing something I didn't see before when it came to those leap options. I know this stock has a history of having some real screwed up option prices because I've already been playing around in this stock and its options now for the better part of a couple weeks. All right? That's why I had it put on our option tools, because I wanted the first cryptocurrency stock that was optionable to be on Tom's option tools. And I wanted to share that with you guys tonight. So there you go. All right. And then keep in mind, you might be saying, you could do a reversal here. Yeah, you could, if you could find out if it truly is, more puts being bought than calls and causing that skew. All right. But maybe there's something else there that we don't know. And then, of course, some of you are saying, yeah, but there's no volume. That's a bad quote. Those are bad quotes because there's no volume. There's only 2 volume and 2 open interest. I'd tend to believe that if I didn't see the bid at 1180 and the offer at 1270, because somebody's out there bidding it at 1180 and someone's also offering it at 1270. So there is a bid and an offer that's somewhere close to the last traded price. All right. Keep that in mind. All right, let's continue. I kind of got a little bit out there, but I saw volatility. And when I thought volatility, the first thing that came to my mind was RIOT blockchain. Now, with most, when I say most, I say almost every single one of the stocks that we look at on tomsoptiontools.com, we have these charts. They're statistical and also implied vol charts. The statisticals show you where the movement is in the stock and when it's not moving at all. Typically, the movement in stock occurs after earnings. Typically, the non-movement in a lot of stocks happen in between earnings cycles. Implieds are quite different. The implieds, typically the implied volatilities go up before the earnings and then crash down after earnings. And then they go up again before earnings and they crash down after earnings. Right? Sometimes it's easier to read an implied volatility chart than it is an actual stock chart itself. For a side-by-side comparison, whether it's Apple, Riot Blockchain, or Priceline.com, I'm always comparing what does the stock cost me and what is the option going to cost me, and based on where my expectation is of that particular stock. So when looking at Apple, we were looking at this stock, and the options would have cost us $15,500. Our break even is where we bought the stock. Right? If the stock were going to go up to 160, what would I make on it? In this case, I'd make 5 points or a $500 profit on a $15,500 risk. That would equate to a 3% ROI. The long call options at the time were $2.50. That same $160 profit target would give me a 2.5% profit or 2.5 points profit or 100% ROI on my $250 risk. Now, I do that with every trade that I'm looking at. Where do I see the stock going if it's directional? And then is that option going to make any money? Because there's several options out there where if the stock goes up, you might look at the option during that same time frame, and it just simply won't make money because the option may have been too expensive. All right? So details. And when I place option orders, I'm looking at details. I double check. What am I buying? What's its expiration date? How much am I paying for it? All right? And then from there, what does the risk graph look like? All right? Where is my out? Where's my stop loss? And I might find a group of where the stock is going. And if we come back down and violate some area of support, wherever we are at that particular day, I might decide I'm done, I'm out. Okay? Trading is not 100% profits. Okay? If there's any guarantees in trading, the guarantee I got for you is you're guaranteed you're going to lose money here and there. That's part of trading. Losses are part of the business. It's containing those losses, all right, and sticking to your plan, which for me produces the most consistent results. So at this point, what I want to do is stop for just a moment, and I want to see, Jay, if you can help me out here. Are there any questions on here that you think You've seen more than once. Let's start with the popular ones. And am I missing anything?
Actually, you're not. There was a recent question from Alan about couldn't you do a spread on that riot lead? And I
Yeah,
answered him,
I opened up Pandora's box there, didn't I?
sure.
That one because but you and I mean, we've been talking about this one for the last week or so, and I was adamant about getting that thing on our tools. It didn't take long. We got those up like very shortly afterwards. But cryptocurrency is all the rage right now, and I'm trying to find at least within Tom's option tools that area where we can start looking at those. All right. By the way, I have something else I want to share with you guys because I'm probably not going to talk about it again tonight. But let me just show you. Those of you that have Tom's option tools, all right, check this out. Go to the stocks page. Go down 1, 2, 3, 4. What do you see there? Cryptocurrency. We have actually started adding cryptocurrency information into Tom's option tools because I want to know what's going on with the cryptos and how they relate to stocks like like Riot. Okay, so you can see here, these are the top ranked stocks or Bitcoin currencies by market cap. So you got Bitcoin in here, which is nearly a 14,667. All right, here's Bitcoin Cash, which was kind of a split off of Bitcoin. That's up 17% tonight. All right, Ripple, which is the cheapest there, no, not the cheapest, but it's pretty close. $1.91 for that coin. There's Ethereum, Litecoin, Cardano, and these are just the top ones out here. But you can access this just by simply going to stocks and going to cryptocurrency. Jay, we haven't even done a video on this yet, have we? Is this
Not yet?
This is
Not
all.
yet.
Yeah, I'm telling you guys, this actually came out like just days ago. That's how fast we had this put up because a lot of people are asking about it, so we have it up there for you. Okay. Let's at this point move into the before I do, let's talk about puts for just a moment, and then we're going to move into some live case studies, starting with today's date and not 2 days ago or 2 months ago, etc. Trading puts for profit. Puts have the same characteristics as long calls. All right, long puts do. Now they have the same contract size, they have the same strikes, they have the same expiration dates, but they increase in value as the stock price decreases. Okay, that's the big difference on puts for any of you that have never traded puts before. And there's a couple of you in here that haven't. I mean, when I started trading options, I was a call guy. Call. Didn't understand puts. Right? It's kind of like reading the Wall Street Journal for the first time. But then I got it as I watched the prices. Okay, and there's a stock that we followed, and we've actually been on this one. This was something that we talked about. Oh gosh, it was before the holidays. I think it was right before Christmas, and it was a company. Let me come on over here and let's go to stocks and let's go to charts and let's go to stock charts. This is an ETF. I'm going to type this one in for you. IYR, and I want to do not 200 days. I just want to do 30 days. All right, IYR. Let's update that one. This was a bearish opportunity that we started looking at right before the holidays. So you can see we were right in this area here. And then, of course, bang, 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 all the way down. And we hit 77. And so you can see here, puts would go up in value as your instrument drops in price. Something else that's going up in value, the implied volatility is going up too. That's also good. If you're long a put option and the stock is dropping in almost every case that I'm aware of, not everyone, but almost everyone, the option prices are going to go up in value too, because all of a sudden you got that fear factor coming in. Where's it going to go? Where's it going to go? Where's it going to go next? And that pushes that implied vol up. Okay, so something to keep an eye on as well. Puts are actually really your best friend when you're on the right side, because you're getting that increase in price and in volatility. You don't get that with call options. Calls prices may go up, but volatility goes down. Right? You don't believe me? Check this out. Let's just look at SPY. SPY is the Standard & Poor's 500 ETF. Take a look. Price goes up, vol goes down. Right? In every situation, with the exception of this bunching that's going on in this case, price went up while vol came down. Price came down, vol creeping up. So this has an inverse correlation, volatility to price with most stocks. All right. Like I said, puts increase in value, stock prices decrease. So what's our mantra? You guys know this. All I did was I kept the mantra that George and I had so long ago. It was basically three things: spot the opportunity, create the low risk trade, and plan, execute, and manage the trade. And so let's go ahead and let's look at what I like to call the flying five. All right. So the flying five is a very, very simple, what I like to call system, all right, for trading. This is a long-term system. This is the first one I'm going to teach you. I'm doing this because, and I haven't done this before, but this is the first of the year, okay? So first of the year, let's take a look at dogs of the Dow, or more importantly, the small dogs. So the dogs of the Dow are the 10 Dow stocks that have the highest dividend yields. We then take the 5 that are the cheapest out of those 10, and that's considered the small dogs. So after the market closes on 12/31, we select those 5 cheapest dogs of the Dow stocks. You invest an equal dollar amount in each of those stocks, and then you hold them for a year. And you get that long-term gain. And then you just rinse and repeat. And guys, where you can get that information, I'd love to keep you on my site the whole time, but I'm not going to. I'm a trader. So I'm going to take you to dogsofthedow.com. You go to dogsofthedow.com, you're definitely going to see something that is a bit confusing. But you want to, read this and you'll get it. But right over here, where you see that little thing that says new, that shows you the dogs of the Dow for 2018. You click on that, and you're going to get this list of the dogs of the Dow. Now, which of these dogs are the puppies? All right, well, we have over here, it's called small dog. And small dog, yes, equals that was a small dog or a puppy, or what I like to call the flying five. All right, the flying five for this year, I'll get to in just a second. But keep in mind, the dogs of the Dow is a stock investment strategy that returns some really nice returns over the long term. All right. In fact, going back into the 70s, it's even better. But small dogs of the Dow have typically outperformed the big dogs. That's why I look at the small dogs. Here's our flying five for this year: GE, Verizon, Pfizer, Coca-Cola, and Cisco. They are the ones that were in the top 10, but they're also the cheapest priced when you look at all of these as a whole. Now, how do you invest or trade in these? Well, there's three things, number of things you can do. You could buy the stock and hold. All right. Right now, since the year 2000, it's averaged about 10% a year, long-term annual results in good and bad. You would buy the stock and sell a covered leap. All right. Now, keep in mind, the reason why you might want to consider doing that is because part of this is stock appreciation and part of this is dividend return. And if you buy the stock, you get the dividends. If you sell a covered leap, all right, like a covered call, but a leap call, then you get the stock plus dividends over the course of the year in most cases. There might be a situation where you get, if you sell that call option, the stock goes up in value, someone might call you out and say, I want your stock. And they're happy to have it if it's mine, because I didn't do it for that long a term. If I can pick up the maximum profit early, I'll do it. But this is what I like out of all three of these, is buying call options. All right, buying those in the money calls using long-term options. And you can go, when you go into money, even one strike in the money might make sense. Even $1 in the money might make sense, because it's all about looking at where you believe that stock price is going to go and then how you can compare that to what you would have bought and held anyway. So we're going to look at the 5 dogs of the Dow right now. All right, so I'm actually going to go over to my tools, and we're going to start with GE. So here's GE. All right, I'm not going to look at a chart of GE. I want to look at the actual options themselves. But you can see here, since we came out of the gate there on the 2nd, GE's gone from a 17 and change stock to about 19. It's gone up $2. That's a pretty decent sized move. All right, just in the last week or so. But I think it has a lot more room to run if you ever knew where GE was. It was much higher than where it is now. So let's take a look at each of these. At this point, I'm going to go to options. I'm going to go to option chains. And I'm actually going to look at each chain of GE with the leap option. So you got January 2019. All right, that's a 373 days to expiration option. I want to look at those, and I want to be looking at those slightly in the money calls. Well, slightly in the money today is the 18 call. The 18 call is trading for $2.51. Nearly a dollar of that is real because the stock's almost at 19. So let's buy that. And at that point, I got my risk graph coming up right now. All right, $251 for this particular option itself, and you can see here that wow, we were all the way up here. Not even in October, we were in the low 20s. If we got into the low 20s, we'd already be at double. All right, we'd already be doubling that particular return on that option. Okay, so that's GE. The January 2019 18 calls for 251. Let's take a look at our next dog up for bids, and that would be Verizon, symbol VZ. Now notice I'm going back in the option chain area. I'm just typing in a new symbol. I'm just going to click on update. That's going to update the symbols. Then the second thing I got to do is click on the leap options, and I'm going to update them. Here is Verizon. Now, I've got a couple of different ideas here. I could look at the 50 calls. I could look at the 47 calls. Now, the 47 calls are 625 by 640, 15 cents in between. The 50s are 430 by 450. All right. Now, the question is, what are the 50s going to be worth if we go 10% higher than where we are right now? So if we went, let's call it 55, all right, 55, 56. What's going to happen is a $4.40 option is going to be worth a minimum of $5 at the end of the year. That's not much. That's maybe a 10%, maybe a 15% return on the actual option itself. What if we went with a 47 call? A 47 call is $6.33. Okay, is that any better? Well, it's a little bit better. All right, but let's go ahead and let's take our 50 call option for now. By the way, could we spread this? Absolutely. Get into that next week. But take a look at the risk graph on this call. So this call is right at $4.40. It is slightly in the money. We know what its limitation is on risk. You know, Verizon had a high last year of it was in the 50. It was in the mid to high 50s. So if we were able to hit this blue line here, all right, this is our standard deviation level. We would definitely be in the profit area. All right, may not be a double, but we could get out there around maybe $400 on a little bit more than $400 risk. All right, that's the beauty of option trading, is that if the stock goes up in the first 3 to 6 months, it might go up 10%, but you have a chance of potentially doubling your money on these leap options. And a leap option, by the way, is any option that has more than 9 months to expiration. That's all a leap option is. Okay, next. We've looked at GE. We've looked at Verizon. Let's look at PFE, Pfizer. So Pfizer, again, 2 clicks. First one to get the stock symbol in there correctly. The second one is to change expiration dates and go with the leap option. Let's scroll down. We see that right now we're looking at a $36.47 stock. Look at the 35 calls. 35 calls are in the money by $1.47. So nearly a half of this price is real money option. Let's hit that risk graph real quick. Take a look at it. Okay. You got a Jan 18 or Jan 19 35 call for almost $3. We know where Pfizer has been. If we get out here into the standard deviation, we're really looking at maybe a $200 profit on a $300 risk. All right. But the good news is that we already got some movement going just for being slightly in the money. Okay, that's Pfizer, the January 2019 35 calls. All right, number 4 of the Flying 5, Coca-Cola, symbol KO. Again, I'm updating the chart. Now I'm going to update the expiration date. So we have that up. Let's scroll down. Coca-Cola is at 46.07. The 45 calls for next year are $3.10. So we do have a little more than $1 of real value. That puts us somewhere around 2 in time value. If I bought the January 19th 45 calls, what is that risk graph going to look like? We all know that Warren Buffett owns a great share of Coca-Cola in the Berkshire Hathaway Fund. If we got into the area of the first standard deviation of this sometime in the middle of the year, we would be looking at about a $200 profit on a $300 risk. We'd probably need a little bit more than that to get us up and into that double. We'll keep an eye on that one. That is the Coca-Cola January 2019 45 calls. Finally, last. Cisco, symbol CSCO. And again, 2 clicks, update the symbol. Now let's update the option chain itself. There we go. And here we are, January 2019. Cisco's at 39.91. All right. Now guess what? There's no 39 call. There's no 38 call. There's a 37 call. $4.78. Now, count with me here, 37, 38, 39, 91. So $2.91 of that 478 is real value. The rest of it's time. Let's just hit that real quick. Click on risk graph. All right. And there's our risk on this trade. And again, we see that halfway through the year, that we have a potential, if we come up to the outside of this standard deviation, of being somewhere around $300 in profit. On about what, 448, is that right? 478 in maximum risk. Okay. So all of these, with the exception of one, let's take a look here. So Cisco was $478. Let's see, Coke was $310. And of course, we saw Pfizer, $299. I'm looking at cost, folks. Verizon, $440. And the first one, GE, $251. Well, they all are under the $500 price tag just for the call options, which is great. Okay. Can we do better? Maybe we can. We'll talk about that next week with spreads. Okay. But those were putting together what I call the flying five and taking a strategy that has been perfected over decades. All right. It has a track record that is decades long. And all we're doing is we're hitching our wagon to somebody else's trading strategy. And we're juicing the returns by adding options. And we're also eliminating a lot of the risk in the event that something goes rogue and gets hurt really bad. All right. Questions, Jay?
Time for a question on that, Tom?
I absolutely do.
Yeah, Robert's asking if you're going to wait all year or would you set a profit target?
Okay. My profit targets that I set on everything is I like to get at it. So let's say I do more than one contract. I like to get out of half of my position. If it doubles in value, I take my money back. Then I'm going to hold the rest, and I'm just going to watch how the market performs. And maybe what I'll do is I'll use something like channels. So let me show you what I'm talking about with channels. Let's go to a stock chart. Oh, gosh, I got enough of them up here. Stocks, charts, stock chart. Now, I can throw GE up here. And, you know, this might get a little bit scary here, but if you throw GE up here, and let's put a, this is a 40-day, right now, a 40-day chart. Now, if I come down here, I've got something called channel test. And so within Tom's Tools, we can do a channel test on anything. We can do up, sideways, and down channels. And I can click on channel test, and it's going to show me, it's going to test out what's going on with the stock. So this stock long-term has been dropping. Anybody can figure that out. But look what's going on medium term and short term. The medium term is we've ran into an area of really good support, and we're about to break. Take a look at this, guys. I don't know. I'm going to zoom in here. Jay, can you see me zooming in? Can you see that?
Yes, we can see you zooming in. Yep.
Okay. I want you to take a look at this very carefully, everyone. You've got resistance on the short-term red channel. You've got resistance on the medium-term green channel. You have resistance on the blue downtrend. We're about to break out of some very, very strong resistance here in General Electric. Now, I can do that with every stock. I can look at Verizon. I can look at, let's put VZ in here. So we can do this on every single one of these, all right? and we can determine based on channels this is an uptrend channel. So as long as we stay in those channels and they don't break down, all right, because this is the second part of the question, I will hold on to these long-term trades, looking at these channels to help guide me into whether or not I want to be out of them. Okay, this is something that channel testing is something that's only available on our tools. All right, there's your channel testing for Verizon. Doesn't show a long-term channel because it was invalid. We have a medium and a short-term, which are bouncing off support right now. Okay, any other questions, Jay?
No, we're good. We're caught up on that.
Awesome. Guys, let me share this with you here real quick. So if any of you want to do this, because we'll look at it next week, let's take a look at the homework on the case studies we talked about tonight in Verizon, Pfizer, Coke, Cisco, and GE. I have some free videos that you can watch at www.tomsoptiontools.com. And if you go and click into Tom's Option Tools, it'll come up like this. Obviously, you can log in if you want to check those videos out, or you can sign up for a 7-day free trial. This is a full trial to our Complete Trader package. And our Complete Trader package includes everything that we have in here. It's everything. We don't hold anything back. It also includes something called Darknet or Darknet strategy, which is roughly a 30-day trading strategy, and our money calendar application, which is also a 30-day trading strategy. They're both different, a bit different. One is in channels, and the other one's based on time, researching time back 10 years. And so you can take a look at those. We're going to go into those next week when we get into spreads, and we'll be bringing up case studies. We'll be bringing up trades in both the money calendar application and the Darknet strategy. So we got a lot to cover next week. I doubt I'm going to finish at 9 o'clock next week. And so with that, Jay, any final comments from you?
Just reiterate that the recording's coming out because people are asking about getting that. They come in late.
Absolutely. Yeah, recording will be out. And by the way, I saw when you click on the free trial, where does it take you? It takes you to any one of these. This is our free trial. It does give you level 1, level 2, and level 3. If you get level 2 and level 3 as your trial, you're also going to get our weekly market alert publication. And we just posted that up tonight. Let me just show you what that looks like real quick. So what you do is in the Tom's Tools area, once you log in and whether you're a member or you got a free trial, you're going to have access to this. Over here on the right-hand side, this is for our partners or our masters. It's a proprietary area that sits out there, but option trader, contrarian trader, complete trader, whatever you signed up for. If you sign up for complete, you get option and contrarian trader. But I want to show you this too. In the contrarian trader section, there's an area that says Tom's newsletter. Just click on that. And that's going to show you every newsletter that we've had since we began this project. This is the newsletter that came out tonight. And we talk about, in this newsletter, we're talking about ETFs. But we also break down stocks, where we see those going, the bond market, where we see that going. By the way, there's some Darknet signals in there, I see. Look at currencies, where we see currencies going. And of course, the commodity markets or the oil market, which has been on a rally. And we were looking at this particular pattern just 2 weeks ago on that as well. And then we'll get into a couple of other things. We get into some different things like this as we're talking about the money calendar. So if any of you want to prep yourself, all right, for what we have happening next week with money calendar, you can get a good prep on that. You find that in Tom's Option Tools. You just simply go in and in the actual option tool piece itself, when you log in, you see those 4 boxes. All right. The second box, which is contrarian trader, the newsletter is found right there. Okay. All right, guys. Thank you very much. Enjoyed it. I hope you did too. Hope you found this educational. If anything, some of you are like, wow, Riot blockchain. I got to take a look at that. But we are really happy to have you on here. And like I said, enjoy the rest of your evening, the rest of your week. I'll be back same time, same day next week. We'll get into review of week 1. We'll get into spreads. We'll get into Darknet. We'll get into money calendar. And we'll get into more trading case studies. All right, guys. Thanks a lot. Have a good night. We'll see you next week. Bye now.